How to look at this Forex market objectively. 1. Abandon their views. 2. Describe the market in terms of its elements. If you're objective, everyone should treat the market in the same way. That's what's objective, what's unchanging. So after throwing away one's own point of view, what's left, in simple terms, is the rule, and how does the rule know it's right? This requires reasoning. It's a basic logic that rules can't be verified. Practice is the only criterion for testing true knowledge, and it is not right to test the rules with practice. The rule that produces it is already right and doesn't need to be tested. Then reasoning is rigorous, and rigorousness is defined by man himself. It's a process of objective research, and then you have to come up with rules that you can use and execute on your own to execute them well. What is a good trading system? 1. Having created a system, we are now talking about a system, which must not be related to people. 2. Based on the characteristics of foreign exchange, it must be independent of the market, and therefore of the currency. 3. The system does not require human involvement. Nothing to do with people is also essentially nothing to do with people, but that point needs to be made separately, without intervention. Let's say you can walk, it's a system, but you never interfere with it. This can only be called a system, it's a natural phenomenon. Once it intervenes, it's abduction for sale and it won't go away. Just like you don't choke even when you eat, it's a system, but you never pay attention to it, don't pay attention to it. So the real system, when it runs, has nothing to do with people. Foreign exchange market certainty. First of all, let's talk about the certainty of the foreign exchange market, and I say this certainty, do not draw it. What I say is what I say, the wording doesn't change anything, it just runs like a system. 1. 24 hours. The 24 hours contains several pieces of information, one on a day-by-day basis and one on funding capacity. It is a parameter of the foreign exchange market. It's like every day the sun rises in the east and sets in the west. So there's 24 hours, it's a day, human behavior is counted by the day, and all business activity settlements are counted by the day. Then the fluctuations of the day, one can study it as a unit. It's really every day to study, it's equal, but whenever you want to study a thing or a relationship between two, the two must be equal. Just like the inflow of money we'll talk about later, when the inflow of A and the inflow of B are equal before you can compare the strong and the weak. But if you don't know that, it's a mistake. So the basic premise of strength versus weakness should be clear, it must be two things equal. Since this is a day, there is a reciprocal basis. Does the time period have a reciprocal basis? The three time periods, Asia, Europe, and America, are the most basic. From the New Zealand opening at 5 o'clock, to the Tokyo opening at 8 o'clock. The inflow of funds is continuous. Where is the discontinuity? The closing of the Americas is discontinuous with the early market. But can't go for New Zealand's currency. New Zealand's currency is relatively continuous because they get up early and they have to lay out the money ahead of time to take into account some of what's going on in the US before the open. It's the fluctuations that occur before 5 o'clock, so you're going to do no New Zealand currency. These two are just discontinuous. For example, after the opening of Tokyo at 8 o'clock, the European market opened to 4 o'clock, 2 o'clock to 4 o'clock, the Asian market ended, and by 5 o'clock or 6 p.m., it was also not continuous with the opening of the morning. The market doesn't superimpose, it reacts differently to fundamentals. Mainly keep in mind the continuity of capital inflows. 2. Geographical economic differences. Geographical economy refers to the difference between time periods. The US economy, for example, is not at all like the Asian economy. Investment in the US economy and Asian economies is also not risk-aware or risk-controlled in the same way. Then we'll make it a completely different style. One thing it is certain of is that the US is a time when capital inflows are relatively large, so it's weighted a bit more proportionately relative to the day. then we all know that the fundamentals are mostly posted during the European and American sessions, if not the Australian dollar. Then the fluctuations that arise at this time can affect the fluctuations of the day. This is equivalent to the timeline being continuous and balanced, but the inflow is different at each point in time. You need to know where the inflow is greater. There's also the fact that investment dollars make up a major share, which can lead to something that can be analyzed. One is that investors must be taking their own money, not the state's. Taking state money may be spent casually, taking your own money must be risk aversion, it is a market certainty. It is an attribute of human beings to seek profit and avoid harm, and in this it is the same, it involves personal problems. So, let's simply extend that, before a fundamental happens, if that fundamental is not expected, it's certain that there won't be an inflow of money, there won't be a large amount of money going in, because immediately there's risk. If there are expectations, what does that expectation refer to? Say a presidential election, the question of which one of the dovehawks is going to come to power, then many funds follow him when he has a clear lead in votes. It belongs to risky money and is bound to pursue risky, high returns. Then ahead of time there will definitely be an influx of money. This one is already seen on the plate, and we'll talk about that later. So many things can be derived from the nature of this capital, which is profit-averse and risk-averse. For example, gaming space, the day inside the last risk event, here when today, the last risk is not released, the short-term funds are not afraid to enter. Because the short-term funds to do is a small direction, small band, follow the current direction to do, it must be waiting for this day to release after it, see everyone's reaction before entering, this is small funds. 3. Focus. We say the most important thing in the market is focus. The first thing to look at in all analysis, regardless of the system, is the focus. If he can't create a new focus, he has to conform to the original. This focus has a characteristic that if the market inside, the thing that affects it the most produces, how far the market goes is not known, how far it goes is not predictable. If there is an expectation of a rate hike that leads to a rise in the euro, then as long as it doesn't end and there are no other distractions, it is bound to go up again, all the way up. Risk funds are exchange rate neutral. Remember that focus must be analyzed, and focus is very simple to look at. Look for a news event, wherever you go, find a news event and look at the plate. If it was this news that caused the plate to rise sharply, with a breakout, then this one stands. That's the focus. Just find a news story and read it on a plate, you don't care if it's good or not, it's none of your business. After the focus is established, it goes in one direction without the next disturbance. What about this starting point near which the focus is generated, the direction? So learning foreign exchange first is to cognitive, do anything is like this. You've been in the industry for more than a decade, the industry is very good, you are also just cognitive better, more experience in this industry. Experience is partly cognitive and partly self-assertive. Just have cognition, plus execution. All your goals are within reach. That's all for today. If you have any confusion about trading, please send me an email. Thanks everyone.